Welcome to Illuminati Silver. We tell you the truth about silver. Today is Saturday, the 30th of September 2023, and we're publishing our Gold and Silver Weekly Update for the week ending the 29th of September. Gold and silver were down considerably this past week, so let's find out why and take a look. Now first, just a shout out to our other channel, Finances Do Matter, where we cover a whole array of financial topics. We've placed a link in the description box below and also in the comment section. Meanwhile, going back to what happened last week and what we are to expect this coming week, well, gold fell $76, falling from $1,925 to $1,849. Having hit a high of 1929 and a low of 1846. A fall of 4%, quite a substantial move for gold. In sterling terms, it finished the week at £1,517, down £57, and for those who've listened to us previously, will know that if we can see gold below 1,500, we will seriously consider buying some, though this is not financial advice. And in euros, it closed at 1,750 euros. That's down 61 euros. Silver fell $1.36, falling from 23.56 to 22.20, having been as high as 23.66 and as low as 22.13, a fall of 5.8%. In sterling terms, it closed at £18.23, and for those who know and listen to this channel, our target in sterling terms is to see it, if it happens that is, below £17 before we become buyers simply because of the VAT. And that's down £1.06 on the week. And in euros it closed at 21.03 euros, that's down 1.15 euros. As a result, the gold to silver ratio rose from 81.7 to 1 to 83.3 to 1, similar figure to what it was 2 weeks ago. The difference between gold's high and low was a considerable $83, and the difference between silver's high and low was $1.53. Now, this is what we said last week concerning our forecast. We expect gold to trade between 1890 and 1960, with 1875 to 1980 as outliers. Well, gold stayed within our outlier range until Friday afternoon, and then crashed through our predictive low and rested just $1 below the low range we have been previously advocating for some time. So this does not augur well. Silver, we said, would be more volatile, and we expect to see it trade between 22.50 and 24.75, with 22 to 25 as outliers. Well, silver more or less traded within our normal range again until Friday afternoon, and then crashed into our outlier range, but still managed to close some 20 cents above our outlier predictive bottom of $22. More on this later. Looking at other financials, Bitcoin is up $407 at 26,987. Equities broadly lower. Dow Jones down 456 at 33,507. The S&P 500 down 32 at 4,288. The Nasdaq just breaking the trend slightly, up 8 points at 13,219, and the FTSE 100 index here in the UK down 75 points at 7,608. Oils were slightly mixed, but still holding above $90. Brent crude closed at $92.20, down $1.07, and WTI crude closed at $90.79, up 76 cents on the week. The dollar index stands at 106.17, on its rise yet again, up 0.59 points on the week. Now, in terms of economic data last week, new home sales for August were down 64,000, and consumer confidence for September was down 5.7 points at 103. Weekly jobless claims were up by just 2,000, and pending home sales for August were minus 7.1% compared with plus 0.9% in July. The dramatic news, which we warned about last week, was the PCE data. The PCE index came in at 0.4% for August, compared with 0.2% in July. Yes, a rise of 0.2%. Though the core PCE, which does not include food or fuel or energy, came in at 0.1% for August compared with 0.2% in July. So we've got a lower core PCE and a higher PCE. This meant that year over year, the PCE index rose from 3.3 to 3.5%, but the core PCE index fell from 4.3 to 3.9%. That was expected. As far as the Fed is concerned, they prefer to focus on core PCE, as they're aware to some degree energy prices are manipulated by OPEC and could change at a whim, and food costs due to transportation are heavily affected by energy prices. This suggests, therefore, that providing future CPI and PCE, the two measures of inflation, data does not worsen before the FOMC next meets and makes its interest rate decision on the 1st of November, so nothing until then, rates may still potentially be held at current levels, though economists are suggesting they may rise at the December meeting. With winter drawing in and a greater reliability placed on energy, unless we see energy prices falling, which we doubt, we would suggest that interest rates should go up in November and leave December alone. We've stated for well over a year that we need to see the Fed funds rate at 5.5% to 5.75% if we're to get inflation down to 2% within a reasonable period of time, and we still hold by that view. Now, this coming week we also have some interesting data. On Monday, we have S&P and ISM manufacturing PMIs for September. On Wednesday, the ADP employment report for September plus ISM services PMIs. On Friday, we have the extremely important US employment, or what was called the non-farm payrolls report for September, whereby any significant deviation from the expected 170,000 new jobs could indeed impact markets. But let's now talk a little more about gold and silver. September saw the largest decline in the gold price since February of this year, just under a $100 decline compared with $108 in February. From a technical analysis point of view, the gold price is below all three major simple moving averages, which are the 200-day, which is the expected length to determine long-term sentiment, the 100-day, the expected length to determine intermediate market sentiment, and the 50-day moving average, the expected length of time to determine short-term market sentiment. Gold's been hit, of course, by a stronger dollar for sure, but also the announcement by the Fed that we're now likely to have higher rates for longer than anticipated. Gold miners have been hit too. The last few years we've seen prices peak in April or May, only to bottom just before October. The question on everyone's lips is, have we now reached that bottom, or do we have further to go? Gold's support zone has tended to be triggered between 1843 to 1850. We're now in that range. The concern is that gold failed to rally prior to the close on Friday. Some analysts are now predicting a potential move down to $1,803. And potentially to 1787 below that, where various Fibonacci targets rest. We're of the view that 1800 is a strong support level, but should rates rise or be seen to potentially rise, then 1750 cannot be discounted, so even below the Fibonacci levels. We sense it's extremely unlikely, though, that gold will fall below that low, and if it did, it would prove to be an absolute bargain in our view. Silver fell to its regarded consolidation level of around 22.50, but also dipped below that late on Friday, and like gold failed to recover, so has held out at this 22.20 level. Having broken below the 200-week EMA, from a technical point of view, silver could easily fall ultimately, not immediately, but ultimately, to as low as $20, a price last seen in March of this year. That said, of course, $22 and $21.50 offers considerable support for silver traditionally and from a technical point of view. So where is our prediction lying for this coming week? Well, so much depends on how markets open Sunday night, Monday morning. We believe there may be a slight rally, but would not be surprised if the descent continues. Now, I know that sounds as if we're calling it both ways, and to some extent we are. There is a lot of data out next week, and Friday, perhaps the most important day of all, could be determinable. We expect traders really to oscillate and perhaps even adopt contradictory moves this coming week, so we are anticipating some toing and froing in these markets. Our best assessment for this week is to see gold trade between 1800 and 1900, with 1775 to 1925 as outliers, and silver to trade between 2175 to 23, with 2125 to 2350 as outliers. What do you think? Do share your thoughts. Meanwhile, we would appreciate it if you would give this video a thumbs up, subscribe, press the bell sign. Also subscribe to Finances Do Matter if you haven't done so already. And as always, we wish you a safe, enjoyable weekend and perhaps a most prosperous week ahead.